Morning everyone, and thank you for joining us today on our Basis Period Reform webinar. I'm just going to walk us through some slides and then we can cover any Q&A at the end. So please feel free to pop in any questions in the Q&A section on your screen. I'm also joined today by Laura Clarkson and Elaine Mitchell from our Scottish Healthcare team, and from our English team we have Melanie Thomas and Lee Simonet joining. Next slide, please, Sasha. Oops, we got it there. So what is basis period reform? So basis period reform is a change in the tax legislation which aligns the accounting year end with the tax year end, and that will be from the 6th of April 2024. This is part of the government's wider tax strategy with making tax digital coming into play, and that's coming into full force from April 2026. The new rules affect all unincorporated businesses like yourselves and individuals who do not currently prepare their accounts up to the 31st of March or the 5th of April, which is in line with the tax year. So this is practices with practice accounts year end of, for example, 30th of June 2023. So there will be the transitional year, which is 23-24, which is the tax year that we're in just now, where we'll look at the additional profits in that period, less any overlap to be relieved. Overlap is a period of profits which have already been taxed twice in the early days of joining the practice or when self-assessment came into force. And they're essentially relieved when you either retire or leave the practice, or in this case, under basis period reform. So it will reduce any additional profits that are being assessed. The additional profits, HMRC have confirmed that those profits will be taxed over a period of 5 years. So the additional profits that we calculate will essentially be spread over the next 5 years' tax returns. Next slide, please, Sasha. So just a recap on the current rules. So your tax and superannuation liabilities are calculated on an accounts year-end basis. So for example, for the 22-23 tax year, we base that on the accounts year ended 30th of June 2022. So the tax and superannuation, therefore, for those years are essentially being paid in arrears. And hence, with basis period reform coming into play, the tax is going to be getting paid sooner. So the year end, some people may wonder, why do we have a year end of 30th of June or 30th of September? And this was just a decision made by the partners when the business was formed many years ago. There would have been specific years at the time. It just depends when the business started trading. Next slide, please, Sasha. So in terms of changing your year end, businesses are not required to change their year end permanently. However, we do recommend that you do. It's not as complicated as you may think, and it actually will be much more straightforward going forward. You know, I think even things like personal expenses, you know, they always run on an accounts year end basis as well, and it can get quite tricky when you're preparing your information for your tax return. It will also align with the tax year end for pension purposes as well. So if you don't change your year end permanently, essentially what will happen is you will have to prepare provisional tax returns and then actual returns every year. That would need to happen going forward, and that will only result in additional fees and additional work. Next slide, please. So just to give an example of how this would work in terms of how the additional profits are calculated and how the spreading is done. So, excuse me, the additional profits, as I said, will be spread over the next 5 years tax returns, with year one being January 2025. That is the first time you will see an additional tax payment. So this example is based on an accounts year end of 30th of June 23. So the 23-24 tax return will be made up of accounts to 30th of June 23, so a 12-month period. So in this example, 90,000. There will then be an additional set of accounts made up for 9 months to the 31st of March 24, in line with the tax year. At that point, we then look at what the overlap profits are, and we would reduce those 9 months period. So in this example, that's additional profits to be assessed of £44,000. And those additional profits of £44,000 will be spread over the next 5 years. So essentially then, so it'll be 1/5 each year for 5 years. So the 23-24 taxable profits in this example is 98,800, which is the 90,000 plus the 8,800. And the tax due on those additional profits would be in January 2025 and thereafter. It doesn't affect your payments on account. It is just, you're not paying anything in the July, it's in the January for those 5 years. Next slide. So HMRC guidance, we can offer either preparing additional set of accounts for that extra period, or an extended set of accounts. So up to and including practices with a year end of 30th September, we would suggesting preparing 2 sets. And that's for many reasons. You know, if you don't, you would be waiting a long time to see a set of accounts, and that doesn't work well in terms of what your capital account balances are and tax estimates. And so that would be running for like a 21 period set of accounts. So we wouldn't recommend that. So we would be preparing a normal set of accounts to 30th of June, and then that additional set of accounts to 31st March. However, if you have example of a 31st December 23 year end, we would propose preparing an extended set up to March, because it's just an additional 3 months. So it very much depends on practice circumstances, you know, depending if you've got a new partner joining or a partner retiring, you know, you would consider then what is best for the practice. Okay, next slide, please. So just a kind of summary of a change of, in terms of change of year end. And for going forward, you know, for our practice managers and looking at what accounts you're preparing up to, what is your year end, the 23-24 year will be those normal set of accounts plus the additional period. And then you can see the 2 years after that, you would just be running to the 31st of March every year. Okay, next slide, please, Sasha. So just some more information on the personal allowance and tax rates. So with the additional profits, there obviously will be additional tax or accelerated tax being paid. For the personal allowance, after your earnings are over the threshold of 100,000, so between 100,000 and 125,000 pounds, you will already know you could lose your personal allowance. So the headline is, with these additional profits, that you will not lose your personal allowance, but essentially the tax calculation, you could be taxed higher if your additional profits takes you into that bracket. You could also be affected by additional tax rates because of the transitional profits created. So the additional tax rate for this year dropped from £150,000 to £125,140. So if you're kind of falling around that kind of level of profits, and you say have additional profits each year of perhaps £20,000, you'd be paying it all at that higher rate, that additional rate, sorry, for UK 45% and Scotland 47. So it's just an area to obviously look at, but that will be built into any tax estimates that we provide you with. And then just on superannuation, so the current rules, superannuation follows the tax guidance in terms of what the account year end is. It has been announced that now the tax guide, the superannuation guidance will follow the tax guidance in terms of basis period reform. So we will be realigning to the tax year as well, and that will result, like you have additional tax profits, you therefore have additional pensionable profits. And like the tax rule, that will be getting spread over the next 5 years. So your next 5-year certificates for superannuation, you will have additional pensionable profits on each of those years. So in terms of estimated pensionable profits, so you can uplift your deductions now if you wish in this current year. We could submit a form to uplift the deductions, or you can plan for the first shortfall in March 2025. So obviously an increase in pensionable earnings can impact your pension growth, and you could see an annual allowance tax charge with those additional earnings. However, as we know, the threshold for the annual allowance changed from 40,000 to 60,000, so we're hoping we won't see much of an issue there for most of our clients. So what should you do now as a practice? So does your practice pay the tax? We don't have as many practices nowadays pay the tax. Normally the partners just pay that individual. But if so, then I would be planning for this additional tax. You know, the capital account may not hold those funds anymore to cover this tax. It's maybe not been considered. So I would definitely say some planning would be needed for those circumstances. So ensure your bookkeeping is up to date. So just not leaving it until the year end. Try and keep the bookkeeping up to date every month, and consider, are you using the best product? You know, if you're using a cloud-based product like Xero, we can obviously access your books and records quicker and produce the accounts quicker at the year end. So, and just providing those books and records to us as soon after your first year end, be that September coming up, have those books and records ready so that we can prepare the accounts, and likewise for the next period to March 2024, because it will be at that case all clients will have a March year end, so there obviously there will be a lot of work to get through, so just encourage having those records ready as soon as possible. Next slide. So just some additional points to cover on this. So if you were to retire or leave the practice, normal retirement rules comes into play for both tax and superannuation. So what that means is any additional profits become payable in that final tax year. So you would lose that spreading over 5 years. But if you're in example year 2, you're spreading for 2 years and then you retire at that point, the rest becomes payable then in that third year. Your tax payments on account are not affected. I mentioned that earlier on. It is just this one tax payment in the January. So overlap will be accounted for in this transitional period, this transitional calculation. So it's important we have this information. In most cases, we will have the information, but it may be on this overlap figure will appear on old tax returns in the instance that we don't have the information. So if you do have any old documents, that would be helpful as well. Otherwise, we do need to get that information on overlap profits from HMRC. Everyone will be affected differently by this. It depends profit levels when you join, profit levels now. It'll also depend on when you joined, the time of year that you joined. In some instances, you may have joined the practice many years ago on a 9-session basis, and you may only be doing 4 sessions now. So there's a variation, and it's not easily comparable with each of your partners. Spreading wise, obviously there's the 5-year rule, but you can disclose this quicker if you wish. If you want to declare those additional profits in the next year, you can. It's not, it might be some people's wish to pay that off sooner rather than later. We're obviously subject to volatile tax rates. We don't know what's going to happen in the next 5 years, but that spreading is the main option, but you can do differently if you wish. So just in terms of what we can do for you is just providing you with those estimates of tax so that you know what's coming and allows you early notice of those additional tax payments. Likewise with superannuation and your annual allowance charges. Cash flow planning, we can offer some cash flow planning, again, particularly with the practices where they pay the tax from the practice and the funds may not be there. And likewise for drawings projections, we can look at, there may be instances where drawings may have to be reduced to help cover the tax being paid from the practice, so we can obviously look at that for you as well. Next slide, please, Sasha. Okay, thank you. I'll just hand over to Laura for the Q&A.
Thank you, Dawn. Thank you for going through that relatively slowly and clearly. Hopefully that has helped a lot of people that are on the call, and thank you for joining the webinar today. At the moment, we've only got 4 sort of questions, comments, so if you do have queries, and whilst we're covering these first 4, please do pop them in the Q&A. So I'm going to take the easiest one first of all. Claire, is it possible to get a copy of the slides and the recording? Yes, after we are finished here today, we will be sending out a copy, a recording, and also a copy of the slides. And you can also get in touch with your sort of local sort of Mazars person, healthcare person, to pick up any other questions that you might have. So the answer to that one is yes. Andy has popped a question in about overlap, which you put in the Q&A quite early on in the webinar, really just saying, is there going to be more of an explanation about what overlap is? Now, Dawn did touch on that just towards the end of her presentation. Elaine, do you want to maybe just to recap on that? If
Absolutely.
okay? Because obviously it can be very different for different people in the same practice.
Yep. So overlap, it was incurred when you first joined the practice and with an account year end that wasn't a March year end. So if, for example, you had a September year end and a partner joined the practice on the 1st of October at the start of a new financial year, the tax rules in place state that in their first tax year, they're taxed from the 1st of October to the 5th of April or 31st of March. The second tax year, they would then be taxed on the account year basis, so from 1st of October to 30th of September. But what that means is the first 6 months, from 1st of October to 31st of March, those profits have been effectively taxed twice. So that 6 months of profits is called overlap profit, and that's then held forward until you, well, based on the current rules, until you came to leave the practice. Now, the reason Laura's and Dawn have both said it can be very different is because it really depends upon when you joined the practice. It could also be different because you might have joined the practice at 4 sessions and be finishing or entering this basis period reform at an 8-session profit share. So it is really very different and can have very different results for each individual partner. Does that help clarify?
Thanks, Elaine. And I think just to add that, we should have overlap profit figures for most clients, and where we don't have that, we are reaching out to HMRC to get that information, and that lets us help build that into any tax estimates that we're currently preparing for clients. For those sort of non-clients on the webinar today, if you haven't already had tax estimates, I would strongly encourage you to ask for those. And if anything still isn't clear, obviously, when we finish this webinar, please do reach out to any of us that are on this panel today. Thank you for that, Elaine. And then the next question we've got is from Michelle, and there's sort of two elements to this question. So the first part of this is about a partner joining just now, so joining in the transitional year, joining in August, for example, August 2023, when there's a December year end, and whether there's any sort of spreading for that person. Now, again, that's a slightly unique situation. Dawn, do you want to maybe come in on that one? And then there's a second part to the question as well.
So the partners joining in
for a new partner just joining this year, so they haven't got that history, they haven't got an overlap because they're just joining in the practice this year.
So no, they wouldn't have the spreading because they're joining in the transitional year. So there would be no need for the spreading to take place for that partner.
So just straight on to a 31st of March basis.
Yes.
Thank you for that. And then the second point, and there's which is about whether you have one set of accounts and an extended set, or, and I'm happy to pick this up, whether you have an extended set of accounts in that scenario with the December year end, or whether you have two sets. It's entirely up to the practice and the partners here. The two sets of accounts give you clarity at a point in time. So if you want that for retiring partners, you want to be very clear about what the capital account is sitting at the date they leave, then you can do two sets of accounts. We always say the difficulty there is you have to pay for two sets of accountancy fees in doing that. Whereas you could, with the December year end, you could simply run to 31st of March, which gives you a 15-month set of accounts, making sure you've got all the appropriate apportionments of income and expenses that are necessary. So not really a right or a wrong answer with that one. It's very much down to preference and just discussion, perhaps, before any work gets started on that. So I hope that helps. And then there's another question has just come in. Practice year end. So thank you, Sharon. Practice year end of June. One partner retiring this year and another within 2 years. Others exiting and staying on. 3 new partners. So basically, there's a lot of change. I think there's a practice with the June year end with a lot of change both now and in the next couple of years. And the question is how to deal with the different circumstances. So I think you did cover this, Dawn, question round about if a partner retires within the 5 years, sort of what happens. Maybe just want to recap on that if that's all right.
Everyone will be affected differently. So each of those partners will all kinds of have different circumstances. So, but again, just to kind of touch on how the spreading will work, there is the spreading over 5 years, but if there are someone who leaves on, say, year 2 out of the 5 years, then the remainder of those additional profits will become taxable. And likewise with superannuation as well, that will all become payable in the final superannuation certificate and final tax return.
Thanks, Dawn. And I think the key is just to have some clarity and some insight as to what these liabilities look like and when they're going to hit the pocket, so to speak. Which is obviously something that we can and do work with clients on. So moving on, sorry, Michelle's just come back. I don't think I've maybe picked up on the question accurately. So Michelle, you're asking if the partner leaves, do they still have the option to spread? And the answer to that one is no. If a partner leaves, it's just like retirement or leaving was before basis period reform came in. You're subject to tax on all your profits, plus profits for the year, plus the additional profits, less the overlap, and you have to pay that tax in a winner. And that's what the system has been until now. So anybody that is leaving now will lose that ability to spread. You have to be continuing in the practice to be able to spread the liability. So I hope that helps. It's great. Thank you for the questions. There's still a few coming in, which is great. So please do keep them coming in if we can help you. So the next question is for Alan McLaughlin. Thank you, Alan. So can Mazars provide any financial advice to try and mitigate the tax liability effects of the additional profits over the 5-year period for those clients who are currently bordering tax thresholds? I'm quite happy to sort of take this one. The key here again is planning. So it's about knowing, what do we estimate the level of profits to be, including the additional profits, and how does that sit versus the additional rate of tax, the loss of personal allowances, the annual allowance. So there's a number of things that have to be considered there. So yes, once we estimate the level of profits, it's not perhaps so much financial advice, as in sort of pensions advisors that are required, but actually just modelling where we think your profits are going to land for a given year and your tax liability against these various thresholds. So the answer is yes, but bearing in mind that to some extent these are always going to be estimates, and we don't know what whilst we will know what the additional level of profits is going to be once we've done accounts to March. We won't know what the annual level of profits is going to be for the next 5 years. So there has to be a level of estimation in there, but there's definitely some modelling that can be done to help plan and avoid the sort of nasty scenario where you're losing personal allowances or have just triggered into the additional rate of tax. So I hope that wasn't too waffly. I hope that helped, Alan. But for any of the people that have posed questions, please do come back to us if we've not answered these adequately.
Can I just add to that a minute, Laura?
Of course.
I was just going to say, one of the vital things to do when you're wanting forecasts and estimates is to make sure your information's as up to date as possible. And Dawn had referred to that during the webinar, but we can give mid-year estimates based on actual information up to the mid-year, but it is dependent on practices keeping their information up to date and updating it on a timely basis.
Yep. No, well said, Elaine. And I think one of the big challenges for us being very honest going forward, and for all accountants going forward with basis period reform, is that every one of our clients will have a 31st of March year end, and the deadline for which is obviously the 31st of January for tax returns. So we are going to have to ramp up our levels of organisation, and in turn we'll be hoping to work very closely with clients to make sure that we are all very clear about timetables and expectations for completing all of this work well within the required timescales. So it's a big change for all of us. Now there's no other questions at this point in time. Please, any of you that are on this webinar, please do reach out to any of us. I've not managed to fire a question to you, Lee. Sorry about that. Lee sat very quietly. He's probably known to some of you for being on our Zero webinars, and Lee's going to be instrumental as part of this, because it's a great way to keep everything up to date, and for us to support clients on Zero by having everything bang up to date by the end of March next year. That'll make a massive difference. So sorry I've not had any questions for you, Lee. You've got a free ride today. But honestly, please do reach out to any of us if there are questions that you've got that we haven't covered, or we haven't covered clearly enough. I think the message is that we need to plan. Ask if you're not clear about what the impact is for you. Ask your accountant, because that information should be becoming available now, at least in estimate stage. And just watch out for further updates that we will be issuing on this. It's important that we're all organised, which is certainly our intention to do that. So I think I'll just double check that there's not any last minute. Yeah, just there was a final question there from Michelle. Should we be requesting estimates for each partner? Absolutely. We're at that stage now where we should be capable of providing estimates for everybody, just to give a wee bit of peace of mind as to what's coming. So, as I say, thank you all for joining. Do get in touch with us if there's anything else that we can help you with. We will send out a recording and a copy of the slides, either just towards the end of this week or early next week, and just keep in touch for any further updates. And thank you in particular, Dawn, for taking us through all of those slides today. It was very helpful. Have a good day, everyone.